In good times, you're less likely to criticize the status quo. But when you've lost something or are experiencing pain, your ability to criticize becomes much more focused and intense.
Governments become much more vulnerable when economies falter. It may also be fair to assume that as economies falter, governments also clamor for greater and greater control. Knowing what we know about the ramifications of the Smoot-Hawley protective tariffs, you might wonder why politicians come back to the idea of trade protectionism. They're politicians. Politicians protect their own interests. The Smoot-Hawley protective tariffs introduced 21,000 different tariffs, more than enough to interrupt world trade. When you see the rate of unemployment rise, it's not uncommon to have trade protectionism become more prominent in Washington.
We just have to be very, very careful that we don't slip back into what we saw in the 1930s, Smoot and Hawley, that took the Depression and turned it into the Greater Depression. World trade collapsed on the other side of the Smoot-Hawley protective tariffs. In an effort to insulate and protect ourselves from pain, we exacerbated that pain and created a negative feedback loop where it was bad and we simply made it worse.
As the economic crisis of the 1930s spread throughout Europe, you began to see civil unrest on a large scale. In fact, the riots in 1934 in Paris almost led to full-out civil war.
Maybe it's not just the French circa 1934. Maybe it's universal, because maybe what is universal is the way humans universally respond to pain and disappointment. We see civil unrest. The Economist wrote about this in 2010 as a dominant theme globally. Civil unrest as a consequence of economic instability. Politics gets messy as people try to maintain control and power in a more uncertain world. Civil unrest is a part of that.
And the pressure on the Chinese continues. Perhaps we should remember the adage,
be careful what you wish for.
We continue to pressure the Chinese to revalue their currency. If it happens in a disorderly fashion, it would be disastrous to the United States. We need our foreign creditors to continue to buy our debt. Without them, we can't live as we have beyond our means. Currency devaluation is the new weapon of choice in an international financial and economic conflict.
When you think of a currency, you don't think of a weapon. You think of something that's fairly benign, useful, store of value, medium of exchange. You don't think of it as an instrument of warfare. And yet in the context of competitive currency devaluation, the weapon of choice is in fact your own currency. It's what you control, and through it, it's how you control others.
As Americans, we live in a particularly insulated world when it comes to our currency, because very rarely do we travel outside of the United States. In Europe, traveling across border can be a daily occurrence. It's a much smaller landscape. It's easy for us to not know what's happening with our currency in the international markets, and to not know that our foreign creditors are already beginning to discount the fact that we're not quite the bet we used to be.
An article written by Barry Eichengreen, published in Foreign Affairs by the Council on Foreign Relations, says this: like its economic logic, the political logic for a dollar-based international monetary and financial system also seems less compelling today. The dollar may have dominated to the exclusion of other reserve currencies after World War II, but this reflected exceptional circumstances. These exceptional circumstances are now a thing of the past.
Powerful groups in New York and Washington, D.C. are recognizing that the singular monetary regime that we've grown accustomed to, centered on the U.S. dollar, is a thing of the past. The Council on Foreign Relations is looking at an orderly transition to shared power structure. What will U.S. foreign policy look like in the context of no longer being the world's reserve currency? It's important to have an understanding of exchange controls, or
capital controls, as they're also called. These are the maneuverings and the decisions made by policymakers when they realize that the end game is on the horizon. When you don't want money to leave the country because you need every dollar available to fix a problem. That's generally when politicians institute exchange controls. It is the equivalent of a monetary Berlin Wall, because what happens is barriers are erected which don't allow a person to leave with their assets. To the average person across the country, this really doesn't matter. Except what it tells you is that the authorities are expecting massive capital flight, and they're going ahead and creating the nets to catch those who would leave the currency. Why is there capital flight at all? It's because there's a growing lack of confidence in the system and in the underlying currency, whatever currency that may be. So investors want to move money to a non-home country, or at least into an asset that they have direct control over. If it sounds like exchange controls and the inability to move money from one country to another is somehow an extreme measure for government to take, it's worth remembering that Europe, even up to 1992, almost every country had exchange controls. This is more common than not. There's two more areas we need to spend some time reviewing. The first is the framework for your personal financial strategy, which we'll do shortly. And then the second is the proactive assignments which you can involve yourself with for the benefit and betterment of your family and your community. How should I make sense of the assets that I've saved? Is there a strategy that can help me make clear decisions and protect the assets that I've accumulated? Yes, it's called the perspective triangle. The three sides of the triangle serve as distinct objectives or mandates given to your savings or liquid assets. Those functions are as follows: insurance or risk mitigation, secondly, growth and income, and lastly, liquidity. Let's consider each function more carefully. Liquidity, by that I mean cash or near cash equivalents. This is vital for household and life management. Whether drawing funds from these cash assets for monthly budget items or spending on extraordinary expenses like a vacation, a new car, having cash or liquidity is absolutely necessary to daily functioning. The advantage of having liquid assets is that when an expenditure arises or an opportunity presents itself, nothing is in your financial planning in the larger picture having to be changed. The disadvantage is that cash pays very little, at least in a zero or low interest rate environment, and over time can be eroded by inflationary policies. What about growth and income? These two categories comprise the traditional allocations to stocks and bonds or their market equivalents. Growth above the rate of inflation has long been a reason to save money, and you would look to these asset classes perhaps to stay above the rate of inflation. Income, on the other hand, from investments may serve the currently employed, say as a personal annual bonus, or for a retiree as a supplement to pension and retirement funds. Market cycles from these complementary themes can add to and create wealth, and it can also take away from them just as quickly, if not managed well. What we're saying is that regular management is important so that significant trends can be taken advantage of, and transitions within the marketplace do not destroy wealth, but add to it. Insurance and risk management, if only there were no risks in the marketplace. But we do find every asset class with a unique list of things that can and do go wrong in the course of investing. The importance of this part of the perspective triangle cannot be overstated. Our first priority as an investor has to be to maintain what you have. Take no catastrophic losses. Start with a priority of preservation of assets. That's your primary goal. The underlying risks are unfortunately out of your control. However, mitigating them and preventing them from having a major negative impact on your total net worth, that is not out of your control. That you can do. It is important to identify the various risks in the marketplace and then address them from a broad portfolio perspective. Let's look at the previously mentioned mandates. First, liquidity. To begin with, you have general categories of risk like financial, economic, political, geopolitical. We've taken a lot of time today to explore those themes. These are merely the broadest categories to help us organize the various risks that relate to a particular asset. More specifically, you find market volatility, market liquidity, correlation, credit quality, and a whole host of other risks which are strictly financial in nature. Inflation, deflation, expanding or contracting credit cycles, demographic shifts, migrations. These are a few of the economic variables that can create risk in a portfolio. Each of these risks can impact an asset class like cash or stocks or bonds. The question is, can you insulate those assets from a large degree of risk? Yes, it is totally possible to hedge almost all of those risks. When we look at the insurance or risk management portion of the perspective triangle, what we're talking about is precious metals. Gold and silver are counter-cyclical to the stock and bond market and protect the cash portion of your portfolio from the damages of inflation. Thus, a balanced portfolio that recognizes and hedges risk, invests for reasonable reward and long-term growth, and allows for daily requirements of household management are all accommodated, all three mandates in a complementary fashion within the perspective triangle. Take a few moments and add up the assets you own in each of these three categories. One for your liquid or cash equivalent assets, one for stocks and bonds, and lastly, one for the precious metals either in your retirement IRA or those in your personal possession. If any of these mandates are unclear or how your personal finances fit into the perspective triangle needs further clarification, we've put together the McIlvanney Financial Group to address those specific questions. On the growth and income side of the portfolio, McIlvanney Wealth Management is very adept, and over the last few years, in spite of market gyrations and significant losses, we've continued to profit. For the risk mitigation and insurance part of the perspective triangle, ICA, International Collectors Associates, is highly skilled and adept at answering questions related to risk management and insurance. On the liquidity portion, our wealth management service also handles cash management, both for corporations, trusts, family offices, and individuals.